Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for October 2017. Well, now we've got Q3 in the rearview mirror, we can look back and say that the third quarter of 2017 was probably the worst quarter for tanker rates since 2011 to 2013, sometime in that period, depending on the asset class. But as we've moved out of Q3 and into Q4, we have just seen that the rates have started to turn a little bit in the last week of September, first couple of weeks of October. And part of that is seasonal. We would expect to get rates moving into Q4 being a bit stronger. And that's because refineries are coming out of their seasonal maintenance programs. Also, as we said on the video last month, refining margins are pretty strong in Europe and in Asia, and that's helping crude import volumes as well. We've also seen the lingering effects of some of the weather in the US Gulf and Caribs region, as we touched upon last month. And then finally, the other thing that's been lifting rates, especially for the bigger ships, is that we have seen a strong pull of Atlantic crude to the Pacific. And that's because the Middle East, Saudi Arabia especially, is limiting their export volumes because they're looking to cut supply and support oil prices. And that's being replaced by a lot of Atlantic crude, particularly from the United States. In fact, last week we saw a record crude export number from the United States. They exported almost 2 million barrels a day, which is amazing considering just a couple of years ago they were exporting basically nothing, and now they're up to 2 million barrels per day. And that oil is moving longer haul. India just took in their first cargo of US crude, and China's taking in quite a bit of US crude as well. So that combination of seasonality, some weather factors, and some longer haul movements of crude is bringing those freight rates up. In fact, on some routes this week on the Aframaxes, we've seen rates above $20,000 per day. So definitely some very encouraging signs as we move into the fourth quarter and the winter market, which, as I said, is usually the strongest time of the year for tankers. Looking ahead to 2018, our view hasn't really changed from the view we've had for a while now, which is that lower fleet growth and a better demand story will lead to a better tanker market as we go into 2018 and 2019. I don't want to cover the tanker supply side too much because we talked about scrapping in our video last month. And also, if you look at our most recent tanker market insights, we did an article on tanker scrapping there as well. But I want to talk a little bit about the tanker demand side. The one real positive factor that's been going on this year and will continue next year is that global oil demand is continuing to grow at a very high rate. In fact, global oil demand is expected to grow by 1.5, maybe 1.6 million barrels a day this year, and by the same level next year as well. So obviously, as demand grows, that requires more supply, and that means more cargoes and more tanker demand. Probably where there's the biggest level of uncertainty is on the oil supply side, particularly what happens in OPEC. As we know, OPEC is cutting supply at the moment to support prices, and those cuts go through to March 2018. But there is some discussions that they might extend those cuts through the rest of 2018 as well. And certainly there might be some merit in that. If you look at the most recent IEA report that came out today, they said that if OPEC keeps their volumes as they are now, it will result in a fairly balanced oil market next year, i.e. inventories will neither grow nor get drawn down. And presumably that would mean that oil prices would stay where they are now, about $55 to $60 a barrel, which I think is where OPEC wants them. So there is certainly a case for OPEC keeping their production volume steady. But of course that assumes that production in the rest of the world carries on current levels. And there are a few areas of uncertainty as we go into the next few weeks and months where we might see some disruption to oil supply. One of those is Iran. And the US is looking at the nuclear agreement with Iran that was signed back in 2015. There's definitely a chance that the United States might decide that Iran is not in compliance and reimpose sanctions. And as we saw with the last round of sanctions, that reduced Iranian crude exports by about 1 million barrels a day. We're also seeing some tension in Turkey and northern Iraq. So Turkey has said that they might cut off the supply of oil from northern Iraq through the Turkish port of Ceyhan. That's about 500,000 barrels a day. And we also see continued volatility in places like Venezuela, West Africa, and there's also the political situation in North Korea as well. So all that is creating quite a bit of uncertainty in the next few months. And if we do see some of those volumes get affected because of these geopolitical issues, then of course it's going to have some knock-on effect. Probably then Saudi Arabia might start increasing their exports. And I think there's again just going to be a bigger pull on Atlantic crude as well, if it's Iranian volumes or Turkish volumes that get affected. So again, that will probably be pulling more crude from West Africa and the United States and Latin America across to Asia. So overall, I think that's probably our biggest level of uncertainty as we go into 2018. But I would say, if anything, it's going to create more volatility and maybe even some more ton-mile demand as well. So again, when we couple that with our view on lower fleet growth into 18 and 19, it again just supports our view of a strengthening tanker market, particularly when we get into the latter part of 2018 and then further into 2019 as well. So that's our conventional tanker market update, and we'll speak to you again next month.